Welcome to our guide on investing $200,000 in a taxable brokerage account. Today, we'll explore a straightforward strategy covering essential topics like asset allocation, tax efficiency, and aligning investments with your financial goals. In this video, we'll walk through the following key areas: defining your financial goals, exploring asset allocation, understanding index funds and ETFs, mastering tax efficiency, emphasizing the importance of an emergency fund, and discussing monthly contributions. We'll wrap up with advice on seeking professional guidance. Financial goals are a cornerstone of your investment strategy. Whether your objectives are for retirement, a future home, or other aspirations, they will significantly shape how you invest. The length of time you have until you need the money, known as the time horizon, heavily influences your risk tolerance. Longer horizons allow for greater risk-taking, while shorter ones necessitate more conservative approaches to safeguard your principal. Diversification is essential in your investment portfolio. Consider incorporating both stocks and bonds. Stocks offer high growth potential but come with increased risk. In contrast, bonds provide stability with less volatility. Your ideal stock-bond mix should be determined by your individual risk tolerance and the time horizon for your investment goals. Utilizing index funds and ETFs can be highly beneficial for taxable accounts. These financial instruments are designed to passively track market indices, providing investors with broad market exposure at a low cost. Importantly, they are also tax efficient, making them a smarter choice over actively managed funds that may lead to frequent capital gains distributions, increasing your tax liability. Here's a quick quiz for you. Which is more tax efficient, index funds or actively managed mutual funds? Your options are index funds, actively managed mutual funds, or both are the same. Feel free to pause the video to think about your answer. We'll discuss the answer in the next section. The correct answer is index funds. They are typically more tax efficient than actively managed mutual funds because they tend to have lower turnover rates, which helps minimize capital gains distributions, thus reducing your tax burden. Tax efficiency is extremely important when managing a taxable account. You'll want to minimize the taxes on capital gains and dividends. Index funds and ETFs naturally help in achieving this goal as they produce fewer taxable events. Additionally, employing strategies like tax loss harvesting can help offset your capital gains, effectively reducing your tax liability. For personalized guidance, consulting with a tax professional is always a wise step. Before plunging into significant investments, it's critical to have a well-funded emergency fund. Aim for 3 to 6 months' worth of expenses stashed away. This acts as a financial safety net, protecting you against unforeseen circumstances and ensuring you don't need to prematurely withdraw from your investment accounts during emergencies. Allocate a portion of your monthly income to consistently contribute to your investment account. By doing so, you'll be practicing dollar-cost averaging, a strategy where you invest a fixed amount at regular intervals. This helps mitigate market volatility as you're buying more shares when prices are low and fewer when high, effectively evening out your investment cost over time. While we've provided a foundational guide, it's important to consider consulting with a financial advisor. They can tailor a strategy specific to your needs, risk tolerance, and financial goals. This personalized approach ensures that your investments are optimized for your unique circumstances, maximizing your potential for financial success. Let's wrap up our discussion. Firstly, be sure to set clear financial goals. Diversify your portfolio with an appropriate mix of stocks and bonds based on your risk tolerance. Opt for tax-efficient investment vehicles like index funds and ETFs. Make sure an emergency fund is in place before diving too deep. Lastly, invest consistently and don't hesitate to seek professional advice for a custom-tailored strategy. Thank you for joining us. If you found this video helpful, please like, share, and subscribe. We'd love to hear your thoughts and experiences, so feel free to leave a comment below. See you next time.